Have you heard of the Oracle of Omaha? You've probably seen his name in articles or across different headlines. He's famous for when and how he made his billion-dollar fortune, and today we're going to cover his journey, investment philosophy, and why the majority of his wealth came after he turned 50. Yes, I'm talking about Warren Buffett. Let's look at the data. Let's start with a little backstory. Warren Buffett was born in Omaha, Nebraska in 1930. By age 11, he had already bought his first stock, which was 3 shares of City Service. He was a natural when it came to understanding how money worked, and he knew that he needed to use his money to invest in different assets. Listen to any of the interviews that he has been on, and you'll hear this. By the time that he graduated from Columbia Business School, Buffett had already studied under Benjamin Graham, who's known as the father of value investing. At 26, he started his investment partnership called Buffett Partnership, and soon after began buying shares of Berkshire Hathaway, which was a struggling textile company that he would later turn into his investing powerhouse. As we speak, Berkshire is about to break the $1 trillion market cap, joining only 7 other companies that have reached that achievement. Even though Buffett was already a millionaire by his 30s, what's really impressive is what happened later in life. It's a perfect example of why time in the market beats timing the market. Warren Buffett is famous for his long-term investment strategy, and don't get me wrong, he has a really impressive track record of returns. But there's no better example of that than his own net worth. When Buffett turned 30, his net worth was around $1 million, which is a great achievement, no doubt. But it took decades for that number to truly skyrocket. By age 50, Buffett had amassed around $300 million. Impressive, but still a far cry from the wealth that we associate with him today. But here's the kicker. By age 60, Buffett's net worth had grown to $3.8 billion, and by age 90, a whopping $100 billion. In fact, over 90% of Buffett's wealth was earned after he turned 50. That's the power of compound interest in action. It's like a snowball. You start small, but over time it builds and builds, eventually turning into something massive. He's proof that it's not about getting rich quickly. It's about taking good actions consistently over a long period of time and not making emotional decisions when things go sideways. He is famous for saying, "Be fearful when others are greedy, and greedy when others are fearful." Buffett's ability to make his fortune later in life ties back to the simple yet powerful investment philosophy: buy and hold. Buffett doesn't chase trends or try to time the market. He buys companies that are undervalued, holds on to them for the long haul, and lets them grow. For example, one of Buffett's most famous investments is Coca-Cola. He bought $1 billion worth of Coke stock back in 1988 and still holds it today. That is a 36-year hold as we speak. That investment has grown by several $billion, and Coca-Cola continues to pay him dividends year after year. Buffett's strategy isn't about trading, it's about ownership. He sees himself as buying businesses, not just stocks. And he sticks with companies that he believes will grow over decades, not months. This patience has allowed Buffett to benefit from decades of compounding returns. And I hope you're gaining the benefits from watching these data briefs. I'm passionate about breaking down the data behind investing so that it's less mysterious and scary. But instead, I'm hoping that you can utilize these to your advantage, just like Warren Buffett. So don't forget to subscribe for more videos like this, and leave me a comment if there's another investor that you think I should cover. Back to Buffett. Now, why did his wealth explode later in life? It boils down to the power of time in the market, not timing the market. Buffett started early, stayed consistent, and let compounding work its magic. Here's an example. If you started with $1 million and it grows 10% annually, after 10 years, you'll have about $2.6 million. But what about after 50 years? You'll have over $117 million. The longer your money stays invested, the more time it has to grow exponentially. Buffett's patience allowed him to ride out market cycles and economic downturns, knowing that over the long run, quality investments will deliver returns. And remember, he made it by staying in the game long enough for compounding to work. And it's a lesson for all of us. The best way to build wealth isn't through quick gains, but through consistent, long-term investing. Even at over 90 years old, Buffett is still going strong, and he's still sticking to the same strategies that worked for him decades ago. He's not chasing the latest tech stock or trying to get rich off the newest trend. His focus is still on buying great companies at a fair price and holding them for a long time. And this mindset is why his net worth keeps growing. Even in his 90s, Buffett's investments continue to compound, generating more wealth than ever before. In fact, his fortune is growing faster now than it did when he was younger because the snowball effect is in full force. Buffett once said, "The stock market is designed to transfer money from the active to the patient. And if anyone is a testament to that, it's him." So what can we learn from Warren Buffett's story? It's not about being the smartest investor in the room, although that's helpful. It's about being the most patient and non-emotional. Buffett's wealth is a product of time, consistency, and letting compound interest do the heavy lifting. The takeaway here is simple. Start early, stay invested, and let your money grow. Thanks for joining me, and if you want to know if your net worth is below or above average, here's my video on that.